This is INBrief with Andrew Hall, Lead Portfolio Manager of the Invesco Global Opportunities Fund, all the way from London. First of all, Andrew, thank you very much for making that trip to participate in the Inside Networks Investment Leaders Forum, Noosa 2026.
Thank you very much for having me.
It's a great pleasure. Andrew, high conviction investing, it sounds simple, but must be difficult in practice because the paradox of how you develop and nurture that conviction and get more convinced without falling in love with the stock.
Yeah, I mean, Warren Buffett often used to say investing is simple but not easy. Simple because the idea of identifying a good business and buying it at a price that's less than intrinsic value is the idea is quite simple. The reason it's harder in practice, I think, is a few reasons. Firstly, investing is incredibly competitive. There are lots of very smart, highly incentivized people all trying to identify good opportunities. So one has to be humble and accept that it isn't easy to find them. And the other issue, I think, is one that we would sort of describe as behavioral. And as human investors, we all have our drawbacks, our behavioral biases, so to speak. And so when it comes to identifying an opportunity, having the discipline to make sure you pay the right price, having the discipline to know when the right time to sell is, having the discipline to accept that your investment thesis might not have played out as expected, those are all behavioral biases that one needs to overcome.
And the challenge when you've got high conviction, but the market doesn't share that and the price falls, that must be some difficult conversations.
Yeah, there's a really fine line between being patient and waiting for your investment thesis to come right, but equally there's a distinct possibility that you're wrong and you need to cut it, and you need to cut it aggressively. And so often, we're spending a lot of time thinking about re-underwriting our investment thesis, checking that our research is correct, and reassessing our position.
Andrew, you have spent some time shorting companies. What did that teach you about business quality, management, and risk?
So I spent 4 years working for Paul Findlay at Moore Capital, and he was a particularly prominent short seller at the time. And I think a few things from that experience. Certainly, shorting, to me, it's almost like the lost art of investing. It's super difficult. If you get a short wrong and the share price goes up, the position becomes bigger. So the problem magnifies. Whereas in long only investing, if you make a mistake, the position becomes smaller and thus less of a problem. And so risk management is absolutely pivotal when it comes to shorting. So I think that discipline around managing risk, assessing when you might be wrong was super important. But also crucially, it was about identifying potential traps. We call those value traps as long-only investors, but assessing where a business might be going from great to good, assessing where a new competitive threat might be coming on, and also the analysis of the accounting. Often what we find is that there are clues in the accounts. When a business is deteriorating, you can see it in things like working capital, provisioning, restructuring charges. And so that discipline of shorting, we find, is very applicable to avoiding value traps in our long-only fund.
We're one quarter almost into 2026, and it's been an amazingly turbulent year already, Andrew. Market environment is problematic in so many ways. But as advisors look to the rest of 2026 and try to position, what trends are you seeing, if you're looking through the short-term, hopefully short-term noise, what trends are you seeing in global equities that could become more prominent?
Yeah, I think, look, there's probably three key issues that are most on our mind at the moment. And as you say, that is outside of the current situation in Iran. I think the first one is just the extent of this investment cycle we've been in over the last 5 or 6 years, that build out of AI infrastructure. A lot of businesses that have benefited from an AI infrastructure build out, that there is certainly a risk, I think, now that we are nearing the peak of that investment cycle. So that's probably the first key issue that we need to be on top of. The second one is just business model disruption. The pace of AI development, the way industries are changing, it really does, I think, require investors to be super open-minded about how enduring the moats of businesses are. And perhaps the most profound question of our day is figuring out how AI is going to impact the working population. It certainly looks as though it's going to be a big boost to productivity, but at the same time, it could come at the cost of significant white-collar unemployment.
In London, where you've worked for most of your career, Andrew, it's one of the great crucibles of investment management. So across your career, what has been the best piece of advice you've received on leadership from some of the people you've worked with?
I think one of the things I've learned over time is firstly, listening to great leaders is really important. So I'm often, listening to podcasts in the car on the way home. But Jamie Dimon often, I think, has some of the great leadership advice. And one of the things he said that really resonated with me is, don't expect anyone to do something that you wouldn't do yourself. And effectively what I think that's saying is lead by example. So that was probably one of the strongest pieces of advice that I've tried to take.
Andrew Hall of Invesco, thank you very much for your time today.
Thanks very much.